Alright, this is your simulation 2. We have 4 exhibits to the simulation. Let us just quickly see what do we have. We have the Tropics balance sheet for the year 6 and 7. Okay, close it down. Then we have the Tropics income statement for the year 7. Okay, we might need it in some of the tasks. And then we have the production and sales analysis email. Okay, and then finally we have the analytics definition. We know these are the formulas we use. So now Tropic Company is a t-shirt manufacturer. Use the information in exhibits. We saw these a little while ago above to complete the task below. The first task, the controller of Tropic asked you to review and explain changes in year 7 working capital accounts. Changes in working capital. And during year 7, what was the company's cash collection amounts related to sales? Enter the amount as a positive whole number. So where do we need to look for? Should we go to income statement that contains accrual based numbers? No, cash information is there. Should we go to production sales? No. Definitions? No. We need to go to the balance sheet. From there we will see the account receivable opening balance, closing balance, the sales number from income statement, and that can give us the idea how much cash we have collected related to sales. So let's go straight to the balance sheet. Okay, now here we go. Account receivables. We have the opening and the closing, and also there is something related to this in note 2. Let us read the note 2 also, so as to see if there is anything important that we need to know. All sales are on credit, fine, and collections take place evenly within each quarter. Balance includes an allowance for credit losses, 400,000 at December 31st year 7 and 100,000 at the December 31st. And the write-offs were 80,000 and 70,000 in year 7 and 6 respectively. Now gentlemen, what we have been given are the net numbers. These 400 and 100, these are the balances of your allowance for uncollectible accounts. So what you see here is the net. So first we will gross it up and then we will apply the idea how much cash we might have collected during the period. Alright, so what we're going to do, we are going to add up the allowance balance in the account receivables net to find the gross account receivable. So what will be the gross account receivable in year 6? I hope you remember, you would have noted it down. The gross receivable in year 6 is going to be 7,950 plus 100,000. This was the balance of allowance. So adding this up gives you the gross account receivables of 8,050,000. That was in year 6. What about year 7? The balance was $400,000. So what you're going to do, 8.1 million, and to that you're going to add $400,000. So that will give you the total of 8.5 million. So this is the balance, gross balance in year 7, gross balance in year 6. So your account receivable balance has gone up from 8.05 million to 8.5 million. So this difference is $450,000. So now we have the opening balance and closing balance of our account receivables. We have these two important informations, sale and the bad debt expense. But remember, very important point, bad debt expense is not to be incorporated in the account receivable account. I will show you. What do we need to take is the bad debts written off. Bad debts written off for the period was given as this one right here. The bad debt written off was 80,000 for year 7 and 70,000 for year 6. So this 80,000 is relevant to us. So let us bring it in. Our income statement is right here. We have the opening and closing balances. Let me draw the sales ledger control account, also called the total debtors account or debtor ledger control account. So sales ledger control account has an opening balance of, I hope you remember from the previous working, the opening balance is 8.05 million. The closing balance was 8.5 million and the difference was 450,000. I hope you remember. Then this is nothing to do with the sales ledger control account. No, this is the bad debt expense, also called the allowance for uncollectible account charge for the year. What was actually written off is 80,000. That needs to be reported here, the actual bad debt. And the sale for the period was 45,080. Now the balancing figure that comes here, opening balance plus credit sales plus sales less bad debts less closing balance, should give you the cash collected from customers. So I'm going to add this up, 45,080 plus 8,050 less 80 less 8,500 gives you 44,500 44,550,000. So it's 44.55 million, and that is going to be your answer that you're going to write in here. It's going to be 44,550,000. Okay, done. Now we have next task. In addition to collection from sales, what other events could explain the greater cash balance at December 31st, year 7 as compared to December 31st, year 6? Select the events from the option in the table below. First, let us see, do we really have a larger cash balance? For that, we need to see the balance sheet, and the relevant part would be the current assets, where we are given the cash balances at the opening 2.62 million versus 3.43. Yes, we do have a significantly larger cash balance. So which of these would explain why do we have larger cash balance? Let us see one by one. A major supplier began offering early payment discounts, resulting in Tropix paying in 15 days instead of 30 days, causing the accounts payable balance to be lower as of December 31st, year 7. So this is basically, it's bad. It will result in more outflow. So this should have lowered your cash balance, not increased. This is incorrect. This is incorrect. So we are going to cross it with red because that is not possible. That doesn't explain why do we have a larger cash balance. An estimated tax payment due on January 15, year 8 was made on December year 7, causing the tax payable balance to be zero as of December 31st, year 7. It's an outflow that would have caused a reduction in cash balance, but here we are seeing an increase. More raw materials were purchased and paid for in year 7 than in year 6 in anticipation of an increase in production levels, causing the inventory balance to be higher. This would have resulted in an outflow. We are looking for the reason why do we have a larger cash balance. Payment terms with one of Tropix major suppliers were revised from 30 days to 45 days, causing the accounts payable balance to be higher than the last year. This is the right justification. This is the reason why we have a higher cash balance, right? That is the right reason. A right reason for it. Year 7 actual sales were below expectations, causing the inventory balance to be higher as of December 31st. Well, could be, but cash should be low in this case. It's not a valid reason for having a higher cash balance. This is the perfect option to go for. This is the one. Done. Next. Cash outflow for non-current assets and liabilities occurred during year 7. In the table below, calculate the cash outflow related to the two events listed and enter each amount as a positive whole number. If an amount is 0, enter 0. Okay, let's see what do we have first. Acquisition of property, plant and equipment. So this would involve the use of your balance sheet, open balance sheet. And we need to look at the long-lived asset side, property, plant and equipment. Here we go. Let us make some room for our writings. All right, here we go. So we have property, plant and equipment. Opening balance 6.24 million, closing balance is 7.04 million. We have note 3. Let's see what do we have here. Property, plant and equipment is depreciated using the straight line method over 5 years to 7 years. That's the time. There were no disposals or write-offs in year 7 or year 6. All additions were paid for during the year using cash on hand. Depreciation for the years ended December 31st, year 7 and 6 was 1,000,000 and 870,000 respectively. So relevant depreciation that we should consider is $1 million for the period. I'm sure you know how to construct a property, plant and equipment net book value account. You have opening balance here, closing balance here. If there is any disposal, it comes on the credit side. If there is any of course there is always depreciation expense that is shown here, and if there is any addition, it is shown on the debit side. So let us plug in the numbers. Opening balance is opening balance is 6240. Disposal, no. Depreciation 1,000 or 1 million. I'm just writing figures in thousands. And the closing balance is 7040. So you need to find this missing number here. So 1000 plus 7040 less 6240 gives you 1800, which means 1.8 million is the addition during the period. So I'm going to add 1.8 million or 1800 and 1000. So that is your addition during the period. Next, payment of long-term debt that was not due in year 7. Now that's little twisted. Payment of long-term debt that was not due in year 7. For this we need to come again on the balance sheet, and you need to see the long-term liability section of your balance sheet. Let me show you. Right here, long-term debt note 5, opening balance 7.405, closing is 6.205. Note 5 is relevant. It says debt was used to finance the purchase of property, plant and equipment. It has required semi-annual principal payments of 150 plus interest due in June and December. The company did not enter into any new long-term debt agreements during year 7. Now if you just look at the opening balance of your long-term debt and the closing, the difference is 1.2 million. Now this is interesting because the difference that we expected should have been just $300,000, because that's what our yearly payment is. Each payment being 150,000. One is made in June, other in December, right? So, but what we see is a reduction of 1.2 million over the period, which means out of this 300,000 was due and paid, but this remaining 900,000 was not due yet paid. So that's the early retirement of your debt. So 900,000 was not due, but despite that we have paid it, and that is what you should write in the position right here, 900,000, and there you go. Okay, so this part is done. What else do we have? We have now the task 2. The controller asks you to provide cash projections for year 8. For each question in the table below, enter the amount as a positive whole number. If an amount is 0, enter 0. For this, we don't need anything else. We need production and sales analysis. Here we will have our projections for the period. So let us bring it in front. Okay. Let us first see what is exactly required so we can look at the exhibit from that particular point of view. What is the projected total cash collections amount during the second quarter of year 8 related to sales? So that is the collection from sales. Let us see just that relevant part only. Okay, now here we go. Dear controller, year 8 expectations are as follows. First quarter forecasted sales are 10 million. Subsequent quarterly sales are forecasted to show 5% growth over each prior quarter. All sales are invoiced on the day of the sale. What else? The collection pattern tells us that 50% collected within the same quarter as invoiced, in which you invoice and you get 50% in the same month, 45% collected in the subsequent quarter, and 5% are uncollectible. Now, if you use this information for the second quarter, what do I have for quarter 2? My collections are going to be 10 million. Remember, 50% is collected in the same quarter, 45% collected the subsequent quarter, and 5% uncollectible. So the first quarter sales, which is going to be 10 million, I'm going to collect 45% of this in the second quarter, which is going to be 4.5 million. Then this sales is going to go up by 5%, which means 10 million to be increased by 5%. And now this is going to be the sales in the second quarter, and I'm going to collect 50% of this amount. Remember the sales collection pattern. It's going to be 5.25. The total is going to be 9.75 million. Remember, it says that the forecast first quarter sale is 10 million, 50% of which collected within first quarter. In the second quarter, I'm going to collect 45% of this amount. In the second quarter, sale is going to go up by 5%, which is 10 million times 1.05. And now I'm going to collect 50% of this amount, which is 5.25. Adding these two up gives me 9.75 million. So this is going to be the collection which I should report there as the input to this task here. 9.75, right? And there we go. Next it says, what is the total projected use of cash during the second quarter of year 8. Now that is a little longer. You will have to sift here and there in this schedule to find what is the total payment. So it is going to be a little twisted. Okay. Now starting from this point onwards, it says raw materials are expected to be 1.5 per t-shirt, and it's going to be unchanged from year 7. Planned production is as follows: first quarter production, second, third and fourth. Remember, the second quarter production is 4.15, and it says that the payment is made. All raw materials are purchased at the beginning of each quarter and paid for within the same quarter based on planned production level, which means our first payment will be for this 4.15 million units, each at the rate of 1.5. So the total payment related to this material is going to be, let me write this down and you should note it down as well. So it's going to be 4.15 multiplied by $1.5, 4.15 million units at the rate of 1.5. So the total payment related to material is going to be 6225, in fact 6225,000. So this is the first payment, you should note it down. Then going back, or down rather, then we have the payment for payroll, indirect manufacturing overhead 500,000, other administrative cost 270. This is all related to the second quarter because all these are quarterly outlays, so it's going to be same for the second quarter. And in the bottom we have approved capital budgeting for the second quarter 250. Khalas, that's all what you have. And do we have anything else given at the bottom? Yes, it says that there are certain semi-annual payments because of the yearly payment made on the long-term debt is year 7. Our semi-annual principal and interest payments for year 8 will be 285 due in June 30th and 282 due in December 31st. So this is not our domain because this is in the quarter 4. We are interested in the quarter 2 outflow. This is 285 that we are interested in. So we'll take this also. And then finally, our scheduled estimated quarterly income tax payment are 160, each due on April 15, which is falling in the second quarter, and the next in June 15. This is also falling in the second quarter. So both of these payments are to be considered, and of course September and January, they are way off. So this 160 twice, this 285, let's just put it all in writing so we know what do we have to do. We have already taken this one. Let's write down these one. So it's going to be payroll. Yes, I will take payroll. Indirect manufacturing overheads. Yes. Then 270 for other administrative cost. Yes. All right, note it down. Let's go down and see what else do we have here. Okay. Okay, so we are going to take first quarter no, third no, just this 250. Then we have something more at the bottom. Lots of payments. Yes. We have this 285 we discussed a little while ago. And then 2 payments of tax 160 each. I'm going to put it at the top. 160, 160. So all these are payments. Taxes, payment for material, payroll. If you collect all these, add up all these, the total should be 10.85 million. 10.85 million. All right, so let's plug it in. Done. All right, what is remaining? Task 3. The controller asks you to suggest 2 changes to improve the cash conversion cycle. Okay, select 2 changes from the options in the table below that you think will be a good way to increase your, to shorten your cash conversion cycle or to improve your cash conversion cycle, to be more precisely said. All right, let's see the first one. It says apply lean manufacturing. Lean manufacturing means minimization of waste and maximization of efficiency to reduce raw material inventory on hand. That is true, because if you hold less inventory, you will have lower inventory turnover days, and that means you will have lower cash conversion cycle. This is true. But why not the other options? Let us discuss these one by one. Buy new t-shirt dyeing equipment to broaden the range of products offering using cash on hand. Well, it will affect cash, but it won't affect the cash conversion cycle because accounts receivables, payables and inventory isn't involved. Pay dividends with funds received from issuance of debt. Cash will go down, but it won't affect your cash conversion cycle because AR, AP and inventory are not involved. Pay suppliers sooner to take advantage of early payment discount. This is not a right approach because if you pay your accounts payable quickly, your AP days will fall and this will increase your cash conversion cycle. Why? Because we know cash conversion cycle is the inventory days plus account receivables collection period minus accounts payable. So if this amount becomes smaller, deducting a small amount from these two will mean you will have a longer cash conversion cycle. So this is not correct as well. Produce more finished goods to increase inventory on hand. Wrong. Having a larger finished goods inventory means your inventory turnover days will be higher and that will increase your cash conversion cycle, not lower. Provide incentive to encourage customers to pay on delivery. That will reduce your account receivable turnover days, average collection period. So this will shorten your cash conversion cycle. So it appears this one and this one, they two are good options to reduce your cash conversion cycle. Reduce the early payment discounts on sales to realize higher revenues. If you reduce the discounts, your AR will take longer time to pay, your AR balances will go up. That means your average collection period will increase. So cash conversion cycle, the length of cash conversion cycle will increase. So it means the only two options that are good enough is the first one and the one that we were just discussing here. Provide incentive to encourage customers to pay early. And then that's all. So your simulation is over. It was quite a challenging one, more computations, but somehow it helped you understand some finer concepts.